Excellent, excellent. Hi, everybody. My name is AJ Brown, and the presentation I've got for you is one of my favorites. It's called Discovering the Exact Four Strategies for Making Some Serious Investment Income. And this is going to turn you into a trading pro. One of the reasons why I like this presentation so gosh darn much is because it works in the market of today. But it's a trading strategy, investment strategy, I should say, that I've been using since 2007, and I've been teaching it since that time as well. So let's get right into it. I want you to take a moment and really understand this graph that I've got up here. Maybe not even as much understand it as I'd love for you to be able to really internalize it. So let's just look at a couple of things. First of all, you can't tell, but I'm writing it in now. This is the zero line. This is negative 20. Here's 30%, 80%, 130%, 180%. And the key here is that there's this range. There's this range high shown by the orange line. And then there's this range low showed by this gray line, and the range low crosses across the zero line and becomes net positive between the 1 and the 2, and then it goes up, and here's what I really want you to pay attention to. It goes up exponentially from there, so that by the time you're at 5 or even 6, the difference between range low and range high, well, it doesn't matter whether something goes to the low side or something goes to the high side, because it's still pretty healthy returns. And so that's kind of what I want to start this presentation by planting the seed. Again, a couple of the highlights: the range low being the worst case condition, crossing above the zero line right away, the range high starting above the zero line, and then it going up exponentially from there, meaning the longer we leave our investment intact, the more it grows exponentially. In fact, that brings me up to the next question, which is, and I always like to do this, I know that you've probably seen this a million times over your lives, but if I were to give you $50,000 today, would you take it, or would you take the other offer I've got you, which is a penny that doubles every month? Which would you take? Think about it for a second. Let's go through the math. So if I gave you that penny, day 1, day 2, day 3, day 4, day 5, day 6, day 7. Okay, I'm a week within that month, and I've only got 64 cents to my name. And I've already spent just about 1/4 of the month. Let's keep going. Here comes day 8, day 9, day 10. I'm about 1/3 of the way through the month, nowhere near that $50,000. Again, 1/3 of my time has passed. But let's keep going. All right, I'm about halfway through the month, still nowhere near the $50,000. I'm at $163.84. I keep going. Gosh, I'm already 3 weeks, just about 3/4 of the way through the month, and I'm only at $10,485.76. All right, this is the last week of the month, and I have finally beat that $50,000. I'm on day 24. I was getting a little bit worried there, white knuckling it on the edge of my seat. But at day 24, I have $83,886. I've surpassed the 50. And then these last couple of days, few days of the month, things really get exciting. Whereas at the end of the month, I'll walk away with about $21 million, $21,474,836.48, just to be exact. That's called compound interest, right? Most powerful force in the universe. I'm not sure that Albert Einstein actually said that, but a lot of people attribute it to him, so there it is. But it is a very powerful force. And if you think back to that graph I planted the seed with, it was showing some exponential gains, right? here's where I want to break this down, right? Because you might say, well, wait a second, you're not going to give me a penny and double it. But what about the whole function of doubling it? How can we do that? And I like to reverse engineer it. What you're going to find out in a couple minutes is that I have an engineering background. So I like to take things and take them apart and figure out how they work. So here's what I found years ago. If you focus on 6% on your money every month, then that investment's going to double every year. And that's not through compounding interest, that's through simple interest, just 12 times a year, right? So what that means is focusing on that 6% goal rather than getting, enticed by all these big goals of like, hey, you could double your money in 3 days or blah, blah, blah. Focus on the 6% per month and I'll double my money every year. That means if I have $1,000, at the end of 1 year, I have $2,012. But it also means at the end of 2 years, I've got $4,048. In 5 years, I've got almost $33,000. And at the end of 10 years, I'm a bona fide millionaire. Even better is what I call having the goose that lays the golden eggs. If I had a $100,000 portfolio, that means if I focus on 6% per month, I would generate about $101,219.65 per year. That is more than the mean income in the United States. I should say median, not mean, because we know that there's a income disparity out there. The median, the most popular in the middle income, is $87,000. Right now, I'm not talking about you folks that live in some of the crazy cities like San Francisco that's blowing up, or even New York, Washington, D.C., Chicago. Well, this is the median for the whole United States. It's $87,000, and that's for somebody who has a salaried white-collar job who works about 60 hours per week. But what's so cool about this is called an investment income. And all of you know that investment income means you're having your money work for you rather than you. So what this means is you're taking a look at your portfolio for about 10 to as much as 30 minutes per evening, and that's it. Otherwise, the portfolio is doing all the work. So let's go into that more detail. First of all, how many of you, and I can see your hands here, there's a hand raising button, by the way. If you take a look at the webinar control panel, there's an orange button with a white arrow on it. And if you look right below that button, there's a vertical array of buttons below that. One of them at the bottom should be your hand raising button. So I'd like to know, with a raise of your hands, how many of you with a show of hands have ever heard of me before? All right. All right. Well, let me ask the other question here. If you click on the button again, it'll put your hand down. How many of you with a show of hands have never heard of me before? And you're welcome to also type it right into your little question and answer area too. Okay. Well, just really quick, my name is AJ Brown, as I was introduced. I am the founder of a company called Trading Trainer. We started business in 2003. People do say that I am the world's most disciplined options trader, equity options to be specific. I sometimes think behind my back they call me the world's laziest options trader. To my face, I like to think of it not as being lazy, but as being efficient. And the reason is because, especially as I get older, especially as you mentioned, or as I mentioned, I've just gotten married. I don't want to be replacing the job that I left. I left my full-time job at Hewlett Packard in 2005, never to take another job because my now investment portfolio was sustaining me. The last thing I want to do is create for myself another job, right? I don't want to be working 50 to 60 hours per week. So I say the world's most disciplined option trader is more like the world's most efficient option trader, right? I like to minimize, number one, the amount I invest to get the most returns, but I also like to minimize my time involved in doing the whole investing thing, right? I am not in it because, right, I have seen portfolios grow big and then grow small again and then grow big. And the scoop is, right, is that money's easy to grow and lose, as many of us know. But time is one commodity that if you spend an hour of your life doing something that, was a waste of your time, you're not getting that hour back. So I am almost militant about not wasting my time. And so I don't want to waste my time doing any of this. I want to get right to the point. I'm very efficient. And I also don't want to, for the time I am spending, have any white knuckle evenings. And what I'm talking about is when I'm investing or trading, there are those times where the market closes and you're sweating all night until the market opens the next day and you see what happens, right? I don't like that. So I don't want to waste any more energy, any more time, any more mental anguish. I don't like the ups and downs. So that's what I think that they mean when they call me the world's most disciplined option trader. I've been doing option trading since 1997, and I started publishing this daily insights for my trading trainer full-time traders, and I do it every night, 5 days a week since 2002. There's also an ebook I wrote back in 2005 that I see on everybody's computer, The 7 Strategies of Successful Option Traders. And I put out this home study course that I see on some of the most successful option traders' bookcase. So I like to know that I've been around for a while. And as I mentioned, I got a degree in mechanical engineering. I have a focus on automatic controls, which is the marrying of electrical and mechanical engineering. I've also got a strong background in commercial business and investing. And for the last 16 years, since I was 30 years old, I started to really get into something called accelerated learning methods and techniques. This is where you learn how to teach people using unorthodox as well as traditional methods to get them to really retain the information. That's what we like to employ whenever we have people come to us at Trading Trainer. We like to get you up and running as quickly as possible. Now, a little history. When I started in 1997, not only did I spend $27,000 on seminars that first year, and we didn't have webinars in 1997. I think at HP where I was working, we had something called WebEx, which was just gaining some foothold, but that was only available to the biggest corporations. For the rest of us in the real world, we didn't have webinars, so we had to go on Saturdays and Sundays. Maybe you guys remember this. You'd go to a hotel for maybe half a Saturday, and then they would get you to pay a little bit more money, and you'd come for all day Sunday. And then if you were really into it, you'd pay even more money and you'd fly somewhere for a week. Do you guys remember that method of learning how to do educating? Some of you have been around as long as that. Yeah? Yeah. So I spent $27,000 on those seminars. Thankfully, I was single at that time. I was in a small apartment working as a pretty big engineer, actually an engineering manager by that time. So I had the money to spend. But not only did I spend money on all those seminars, right? I also gave 85 grand back to the market that first year, making stupid investments. How many of you, with a show of hands, can identify? Trying to follow these gurus' plans, right? And in fact, I like to spend at least this much every year on continuing education, mainly so I can bring it to my folks so that they, again, don't have to do the same thing that I've done. But I try not to make the stupid investments anymore following these gurus. And I'll give you a little hint. I cornered folks that I was seeing, schleps like me. I cornered them at the water cooler after about 9 or 10 months of this cycle of every Saturday going to one of these seminars, then going home and trying these programs and losing a ton of money. But by the way, I lost more money that first year than it cost me for my college education. But then again, I figure that it was all part of my more useful college education. But the scoop is I cornered other guys that look like me, and gals for that matter, and I got them to join in with me, and do this stuff together. And I want you to write that down, investment groups, right? A lot of people say find a guru that you can trust, and that's definitely super important. Find somebody that you can follow in their footsteps, and more importantly, find somebody who actually is doing what they say they're doing, not, you know, doing something that perhaps they did 20 years ago and now they're just selling the education to it. Make sure that they're doing what they're doing and you can follow in their footsteps, but also do it with a group. That means join an investment group and all be on the same page, have people in your family do it, because it turns out you guys can check each other's work, you can hold each other accountable. So find an investment group. Do not Lone Ranger this, okay? So that's one of the first tidbits I want to give you. The last thing I want to tell you about me before we get back into the content here is my foundation. I always like to pitch my foundation. I started in 2003 taking 14 gangbangers off the streets of Denver, Aurora, Denver. And I'll be honest, only 9 of them finished my 6-month program. 5 of them washed out. They just weren't interested in the long term. But those 9 that finished, as a thank you for getting through my program, I gave each one of them $2,000. And I was thinking, I'll never see this money again. And it turns out that all 9 of them, if you can believe it, paid me back. Now, these are kids that had less than a 4th grade or 10-year-old education, even though they were all in high school, getting ready to graduate high school. The school system was basically just trying to push them through so that they didn't have to deal with them. They had about a 4th grade education, and they didn't have computers at home, let alone connection to the internet, either through, at that time, dial-up or even DSL. So we were doing this at the public library, and the public library put a limitation on us of only, get this, 30 minutes a day on the computer. So we had to, not only with their limited education, but also with the limits of time accessing the trading boards at the time, figure out how to do this. And we totally did. Not only did they all pay me back, but they all went on to buy their own computers, get their own home internet connections like DSL at the time. And a few of them actually went further. One of them actually sent himself to Denver University. Now, since then, I have taken my foundation from 14 kids. We have moved it over the years. It now resides in Chicago in a partnership with the Chicago Board of Options Exchange. And last year, we had over 170 Southside Chicago kids get through our program. So I'm most excited about this. And what's cool about this trading trainer company that I started is that all of the coaches that work for me pretty much donate their time. Trading Trainer gives all of their profits, this education company I created gives all their profits to my foundation. So one of the things is, if you ever call my office and you talk to me or one of the other traders, you'll know that you're talking to somebody who actually is trading real time to support themselves through investing, because we don't make any money on our education. We give it all to the foundation. It's pretty cool business model. All right. So let's get back to the content. You ready? What minimum returns must you make in order to double your portfolio annually? 0.5%, 1.5%, 5%, 6%, 10%? If you remember that the number is 6%, right on. So what do we invest in to actually sell, to actually make those type of returns? What we're doing is we're selling option premium. So what the heck is this option premium? Well, really straightforward. When you look at any option price on the CBOE board, like for instance, an option is trading at $7. That $7 is equal to a component of that option price, which I call the in the money value. For you kind of nerdy people like me, the academic term is intrinsic value. And there's also a component that is the premium value. Nerdy term, academic term, extrinsic value. So intrinsic and extrinsic value, add them together and you'll get that $7 on the board. Now, the scoop is, right, is if you're not in the money with the option, then the in the money value obviously is going to be zero. So that means the option price is equal to the premium price. If there is any in the money value, meaning the option's in the money, then whatever is the difference between the option price and the in the money value is that premium value, right? By the way, good question somebody put into the chat board. What about implied volatility? Does implied volatility, how many with the show of hands who are familiar with options, does implied volatility have anything to do with the in the money value? Absolutely not. The in the money value, by the way, if you want to write this definition down, is the value of the option at expiration, right? And so it has nothing to do with theta decay, time decay. It has nothing to do with implied volatility. Premium, this is the emotional component of the price. This has everything to do not only with the directional component of the underlying symbol, but it also has to do with how much time is left and how much implied volatility. So that is in the premium value, and then the in the money or intrinsic value is the other component. So there we go. So that's your option price. So I'm focusing on this premium. Now, some of you might be saying, now, wait a second, AJ, I'm a commodities or a Forex trader, or I trade baseball cards. What the heck is this option? So just really quick, for those of you that need to be brought up to speed, this option is a financial instrument. They call it a derivative. Another kind of derivative is a future, but we like to focus on options. Options are typically bought and sold to hedge risk against stocks, indexes, and ETFs, exchange traded funds. But that's not how I'm using them. I'm actually using them in order to profit through selling that premium. So here are 4 simple transactions. A covered call, a covered put, that's where we flip the covered call upside down. A lot of people, by the way, are interested in covered puts these days because they feel like the market is a little bit overbought, and any minute now the market's floor could fall down. Covered puts profit to the high side when the underlying symbol crashes down. So a lot of people are interested in covered puts right now. And then there's this kind of putting on steroids, the covered call. It's called writing a covered call against a leap. I call it supercharged covered call writing. And again, I like to cater to you academics out there. The academics out there, we would call this a bull call diagonal debit spread. We could also write a covered put against a leap, supercharging the covered put writing. And again, bear put diagonal debit spread. So let's go through an example. This example I took a couple weeks ago. Options for October literally expired yesterday, but a couple weeks ago, GE was trading at $9.38. Now, this example is just for you to understand kind of in concept what we're doing. The scoop is that we actually are demonstrating the worst case scenario right now, and it's called a buy right. It's where you buy the stock and sell the call at exactly the same time. In practice, we generally like to keep a couple days in between so that we can buy the stock at the best price possible and then sell the call at the best price possible, so we get much better results. But let's go. $9.38. Then we can sell back that GE call. Notice that the GE call has a strike price of $10 at 13 cents, right? So in other words, we create an instant dividend of $13 per option contract sold. Many of you know that options are sold in lots of 100. Basically, what we've got here is a coupon. Think about a store that gives out a coupon, or a pizza place that gives out a coupon. They're actually banking on you not using that coupon before its expiration date. If they can get you to not use that coupon before the expiration date, especially if you had bought that coupon in the form of like a coupon book, you paid money for it, then they actually went out, right? So this is like a kind of coupon, or it's a way to buy GE at a discount, right? Because here's what happens. What happens if GE closes above $10 on October 18th? Well, you're going to get that $10. You get exercised out. So you make 62 cents there. Plus, you got to keep the 13 cents that you made by selling the coupon in the first place. So you get a total profit of 75 cents, which actually works out to a really healthy 8.2% return on investment. But now, what if GE is flat by October 18th? Well, we keep GE. We got to keep our 13 cents. We get that 13 cents and it carries over. So we made about 1.4%. Again, this is the worst case scenario because we can definitely get better prices for GE in the option. But 1.4% in this worst case scenario. But here's the cool part. We're going to do it again. And we're going to do it again. And we're going to do it again. So we actually like this particular scenario. But what happens if GE drops by October 18? Well, the cool part is even inherent to this strategy, because I have that 13-cent reduction in the price of the underlying, I call it a profit buffer. GE has to drop at least that 13 cents. Otherwise, I've got a break-even trade or even better. In other words, I've got a profit buffer built in. Now, in a couple minutes, and I'm going to watch the time because I want to make sure I cover everything here, I can actually collar this position and stop the loss at a given price even better than this. But the cool part is inherent to the premium selling process, I have a built-in profit buffer. So my break-even price is $9.25, right? All right. Here are some gains just from some covered calls. 17% on Micron in 12 days when the stock went up. 15% on Activision in 34 days when the stock treaded water. And we had 14% on Allscripts Healthcare in 86 trading days when the stock took a dump. So before I go to the next piece of the puzzle, let's do a little check here. What does investing by selling premium create? Does it create an instant dividend? Does it create a discount on the underlying security? Does it create a profit buffer? Does it act like an expiring coupon? Answer all of them that apply. What do you think? If you say all, you're absolutely right. Some more gains here. 21% on Caesars, 12% on St. Joe's, 17% on Community Health when the stock took a dump. All right, now I'm going to ask you a question in advance, see how many people are engaged here. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? What should we do? Pick one. Should we sell out-in-time options? Should we replace the security with options trading at parity? Should we just give up on this whole thing and buy mutual funds? Or is what I'm even talking about not possible? I see people typing their answers into the Q&A. Some people are typing in sell out in time options. That actually is not that good. Let me explain that one really quick. If you look at how that premium decays with time, we call this theta decay in the nerdy world. The amount of time, say for instance, this is a month, this is the second month, and this is expiration. By the way, option traders, you might want to write this down. You know, we always hear that there's only two things true in life, right? And that is death and taxes. It turns out option traders believe three things. Besides death and taxes, we know that option premium will always expire worthless. No matter what the IV is, no matter what the underlying symbol price is, the premium component of an option price always expires at zero. It turns out that last month when an option is near term, that's when you get the greatest amount of movement. And so if we sell the premium for this price, then in short order, we get to make the spread, right? The difference in price. If you sell farther out in time options, the amount of returns versus the amount of time you wait isn't much greater, if that makes sense. In other words, the amount of time you sit in an investment allowing it possibly to go wrong, and you don't get much bang for your buck for doing that. So we always like to sell, please write this down, near term at the money options. That's going to give us the biggest bang of the buck. So it turns out selling out in time options is not our best bet, but a lot of you who are answering along did get the right answer. We like to replace the security with an option trading at parity. So what are options trading at parity? And don't get this confused. Some of you smart folks are saying, well, it's a synthetic equivalent. Actually, it's not the same thing. A synthetic equivalent, for instance, is like the difference between a bull call vertical debit spread and a bull put vertical credit spread, or the difference between an iron condor and a condor. Those are synthetic equivalencies. What I'm talking about is realizing that option premium is the most when the option is at the money. That's why when we sell premium, we like to sell near term at the money options. Excuse me. When we go deep enough in the money, the option actually loses most of its premium. In fact, that's what we target. We target to have less than 5% premium. And that means we're so deep in the money that the option is almost completely intrinsic value. What does that mean? It means that a deep in the money option behaves exactly like the underlying security. So for instance, if the underlying security moves up $1, so does the option. Dollar for dollar movement. The only scoop is that these deep in the money options are a much cheaper price, right? That's how we supercharge the security. So the next question is okay, I'm going to go deep in the money and I'm going to find an option to substitute, but how far out in time? Well, let me give you some statistics really quick. For folks that have been using my program that we coach independently, we have found that they stay in their positions a mean 5 months. Now, that is a flat bell curve. That means plenty of people stay in only 3 months. Plenty of people go 7, even 8 months. Just this past September, I was in a position that lasted for 9 months, which is really nice. Now, what's neat about that is also some other statistics you should write down is in order to vest our whole portfolio, and this is a portfolio, we have people with portfolios as small as $800. We have people with portfolios that are now approaching 8 figures, 7 figures, like $7, $8 million. Then you're talking, over 10 million. No matter what the size of the portfolio, it tends that with our risk models, we wind up vesting the whole portfolio in somewhere between 3 and 7 positions, depending on which strategies you're employing. So if you kind of think about it, if we have our portfolio in 3 to 7 positions, and on average, they're lasting about 5 months, could go as long as 8, maybe 3, and these things are, exercising or, at different time periods, it turns out, please write this down, we're only cycling in 1 or 2 new positions per quarter. And again, I want to emphasize the efficiency of our investing. It's not, if you're interested in doing some day trading, this is not the place for you, right? What we're doing is basically creating a passive investment portfolio that we check in just a couple of minutes every evening to see what it's doing. And then that's about it, right? 1 to twice a quarter, we're looking for a new position to roll into our portfolio. But otherwise, this thing is just like an ATM machine. Now, back to the question of how far out in time. Well, if we're talking about positions that could last 7, 8, 9 months, we want to go far enough out in time that this back month option isn't going to rain on our parade by expiring, right? We don't want that back month option. If we're collecting premiums every week, if you're using weekly options, or every month if you're using monthly options, we don't want the party to stop. So we would rather be exercised out of the position rather than have that back month option expire and have us to go do unnecessary work, right? That's not efficient at all. So the answer is we buy our back month option far out in time so that the substitute option expiration will not interfere with selling many cycles of premium. 8, 9, 10 cycles is what we plan for. So we typically use option leaps thanks to the liquidity. And you can find option leaps in your equities, in your indexes, in your ETFs. So let's do an example. Let's just take that same General Electric. We could use General Electric, or we could substitute with a option that has close to that 5% premium value. This is the General Electric 2021 $5 call. It's going for just a little bit more than half price, right? So what if we do the math on that? So we buy that 2021 call for only $4.70. We still get the 13-cent premium for selling the near-term at the money option. Still get that instant dividend of $13 per option contract. So what happens if GE closes above $10? Well, we're going to get to keep $5 of it. And think about the definition of options, right? With the definition of options, if I get exercised at the $10 strike price for the option I sold the premium on, I'm going to go back and exercise this option that I bought for $4.70. I get to keep the difference. So I get to keep the $5 spread. So that gives me 30 cents plus the 13 cents. I get 43 cents, but my 43 cents is now on the smaller break-even price, right? The smaller cost basis. So I've got 9.4% ROI, and I got to invest a whole lot less of my portfolio. It's cheaper. It's good for if you've got smaller portfolios. Now, what if it's flat? Same thing. This time, because again, I'm on a smaller cost basis, and again, these are the worst case scenarios. We would definitely be getting better prices than this. But now we're set up to do it again and again. This is the ideal situation. And of course, we've got that built-in profit buffer of 13 cents, meaning we can drop all the way to 4.57 for the break-even price. Here are some of the gains. I'm not going to stop because I'm looking at the clock and I want to make sure I finish on time. 43% on the index when the stock went up, 9% when the stock traded water, 2% when the stock took a dump. So now let's go to the third part. We figured out how to sell premium. We figured out how to supercharge that premium. Let's talk about reducing our return on risk. How can we do that? Should we sell half as much option premium? Should we sell the out in time and options? Should we collar the investment by marrying a protective option? Or is what I'm talking about not possible? What do you think? If you think the answer is collar the investment by marrying a protective option, you're absolutely right. Let me actually show you a live example. So I've been trading Ericsson for a while here. Let's see if we can pull this up. Here's what I want you to take a look at this spreadsheet. This is one of my actual trade logs where I keep track of all the transactions. I started trading Ericsson over a year ago. Check this out. So I bought Ericsson for $8.30 a share. I bought 1,100 shares. I immediately, not immediately, you see I bought that on November 23rd. And if you take a look, let me bring over here. I was showing GE, but let me, this is my Thinkorswim here. I like Thinkorswim because it's a nice free service here. I'm going to pull up a one-year chart. Let's see, here we go. So November 23rd, you'll notice that while Ericsson was channeling here, I waited for a bottom to be found, and I bought shortly after the bottom is found where I could look in the rear view mirror and see that I had hit a low. That's when I bought Ericsson. And then if you look at the date of when we sold our premium, we did the same thing. We waited for the top to be found. So that's what I was talking about waiting a couple weeks and getting the best price. So when I sold that premium, I made 20 cents. And then you'll notice shortly after, that was a Friday, December 14th. December 17th, I went ahead and bought an $8 put. Again, bringing up that chart here, you can see that now that by buying that $8 put, I have hedged myself so that anything below $8, that put will pay me dollar for dollar and offset any losses. In other words, I have now shunted the losses completely, even past my profit buffer to $8. A lot of people worry about that with selling premium, but by collaring it, you totally protect yourself. So I bought that for 5 cents. Notice I bought that, again, at the top of the channel when it was the best price. Now, of course, time went by and that 20-cent option expired worthless, so I got to keep the 20 cents. And when I hit that bottom, that put was now worth 25 cents, so I sold it back. So not only did I, and if you really get this, if you've been, not only am I making money on the premium trade, but I've also, and this is very unique to the way that we're doing this, I'm profiting secondarily on the whole insurance game, right? I'm buying and selling my collars, just adding an extra transaction per cycle, and now I've made just as much as I made on the premium. Notice just after this first cycle, my cost basis is below the $8 I'm insuring. I did it again. I repeated, right? I sold the call and I bought the put a month out, right? 20 cents, 20 cents. This time I didn't get as good a deal at the 5 cent mark for the put. I had to pay 20 cents for it. That first premium expired worthless. I sold the put back for 25 cents. Now my cost basis is down at $7.70. Again, what does it mean when I'm insuring at $8 and yet my cost basis per share is down at $7.70? Think about that a second. I did it again, and I did get exercised right here in the month of March. At that point, I got exercised at the $9 price, and I had paid $8.30. But not only that, my cost basis had dropped all the way down to $7.20. So I wound up making a $1.79 price profit. And then notice what else I did. I know Ericsson. I've been trading Ericsson for a while. In fact, if I show you a 2-year weekly chart, you'll see that Ericsson has a tendency to channel sideways, which is ideal for what we're doing here. So I waited a couple of months. I'm coming back to our 1-year chart. I waited a couple of months, and then as soon as Ericsson started channeling again with tested support and resistance, I started the whole process all over again. So I took that initial money, I put it back in, and I've been trading it ever since, right? So Ericsson is a real nice thing, but I wanted you to notice a couple things. Number one is how fast did this trade become better than what I was insuring it for? And also how I not only am making money on selling the premium, but I've also taken a very novel approach and am making money on the actual collared protective options too. I've got now 2 economic sources into my investment portfolio. It seems complicated, but it's basically we've taken something that's usually a cost center and turned it into a profit center, which is the actual insuring of the trade. It's pretty rad. So back to this. This is actually the chart for Ericsson. And so what we're noticing here, again, bringing back this break even, we got above the break even point within the first month. And it could be weekly if you're using weekly options. It could be within the first weeks. And now you get to a point where you're 5 or 6 months into the trade, and you don't care if the whole position goes against you versus going for you, because in either case, you've locked in your gains. And the bad case scenario isn't as bad as the worst case. A lot of people ask me, AJ, with this strategy, what's your win-loss ratio? As you can see here, even if I lose, I'm going to make something like 78% profit versus winning where I'm going to be making something around 87%. So do I care about my win-loss ratio? Not really, because losing and winning is not much different. Does that make sense? I know that's hard to grasp for some of you directional traders out there, but the fact that we're just letting the decaying aspect, the fact that options have a theta decay to them, we're profiting on that mechanism, which is way more reliable, especially since the beginning of 2018, end of 2017, when the Trump rally ended. And now, your guess is as much as mine as to whether the individual equities or indexes or ETFs are going to go up or down per day. Directional trading is very difficult. This, is just time passing by. It takes a lot less effort. It fits my definition for being an efficient trader. So what do we have when our cost basis, our break-even price, is less than our protective bailout price? What do you think? Is it a risk-free investment? Is it a losing trade? Is what we have too much complexity, or is this a pipe dream? What do you think? Think about my Ericsson trade. What do we have as soon as the collar is no longer smaller than our cost basis? What if our cost, it's like, what happens if you have an insurance policy on your home for $300,000, even though your home is only worth $100,000? You have what's called a risk-free investment. If all hell breaks loose and your house burns down, you're going to get more money than the house is worth. All right, so let's review these 3 steps. Get your pencils out. If you're confident, get your pen out. We're going to buy or short an underlying security, or even better, we're going to buy a substitute option trading at parity. Next, we're going to sell a near-term at-the-money option for its premium value. This is going to create an instant dividend or a profit buffer. And then, at the same time we sell that near-term at-the-money option for its premium value, we're going to collar our position with a married option that's at least 1 month out. In fact, what we like to do, honestly, is go 3 to 6 months out. That creates an even better trade. And that's going to protect our investment. We're going to turn this into a profit center instead of a cost center. That's what our whole program is about. The other thing is you'll notice right here, we talked about that buying a substitute option, trading at parity, not only reduces our cost basis, but look at what else it does. Notice I said the word buy here versus buy or short. In the case of a covered put, we're shorting. Most of our people that are trading with us here at Trading Trainer in our premium selling program are doing this in their tax deferred or tax-free accounts. Their IRAs or their RRSPs if you're up in Canada. The scoop is those IRAs or RRSPs are not going to allow you to do margin trades. So there's not going to be any of this shorting an underlying security, but we can get the same exact mechanisms of profit to the downside as a covered put by substituting that option trading at parity. It's kind of awesome. We can get our protection to the downside by doing the covered put trades, but by doing a covered put against a back month deep in the money leap, we can get a cash trade out of it. So here's where I say, how would you like to never miss one of these picks, minimize the amount of time you spend away from your loved ones, and have the support whenever you need it to do this? Because that's what it's all about, right? It's all about saving time, creating clarity, and getting results. And I'm talking about cash money results, either every week if you're doing weekly options or every month if you're doing monthly options. So would it be okay if I take a couple of moments at the end of this session to tell you a little bit about my materials, my training, and tools to see if they are a match for you? Thanks. So this is for someone who doesn't want to pay for multiple data subscriptions, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things, doesn't want to do this alone, wants step-by-step instructions. This is for somebody who wants to get consistent, reliable results. One of the cool things, I'm going to go ahead right now. I'm going to kind of interrupt my presentation here. I'm opening up a browser window, and I'm going to log into our subscribers area of our web portal. Got all our webinars listed. Here's the premium selling area. Notice we've got this cool premium selling screener. This premium selling screener, as you can see, runs every evening and looks for the best tickers to write premium on, right? It looks for the tickers that have the best bones. The reason why we do that is because it turns out our screener, where is that? I just went from it. Our screener goes through, yesterday it went through over 11,900 underlying symbols. Those are stocks, indexes, ETFs. And then it went through the option chains that come with those symbols. That totaled almost 1 million lines of data. And it mixes and matches and it tries to find the best combinations. If you were trying to do that on your own to find some of the best underlying symbols to do these strategies against, it would take forever. So it's one of the reasons why I personally like our program, is because we've got this cool screener that I came up with. In fact, I'm always looking for new algorithms. I've got some beta screeners that you can see here that we can run every evening as well, right? Sometimes it finds good candidates, sometimes it doesn't. We even have this other algorithm. So this program's been around since 2007, and we're constantly tweaking the algorithms to stay current. It's kind of cool. All right, back to the presentation. Quick testimonial. Charlene. Charlene was somebody who was a teacher. I think teachers are the best thing in this world for our kids, and I think that they're undervalued. She'd been a teacher for 29 years. She did get sick. She was ordered out of the classroom. She actually wound up getting cancer. She got to the point, I mean, she stayed on for as long as she could. She had 13 years left until she could get her teacher's pension, and they ordered her out of the classroom. She just got too weak. And she actually thought she was going to pass away, and she was peaceful about it. But then she had a recovery, right? The problem is especially in the US, when you recover, what do you wind up with? A lot of medical bills. And usually the sickness has made it so that you can't bring in income. So she had no livable retirement coming in. She wasn't able to collect Social Security for 10 years. So she got interested in the stock market, and the rest was history. She met me. Not only is she going to make a living, now she's traveling. She uses our instant income calendar tools. She reads the daily table, finds the stock that she's interested in, follows the strategy. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So really great testimonial. We love Charlene. We have once a month training webinars. They actually happen. This one for the month of October is happening on Tuesday evening. And this is where we do a deep dive into one piece of the process. And we create replays. You can see that in our web portal here, if I go to the home page and I scroll on down to, you can see we've got our replays of all the webinars that we've ever done. And they're searchable, so you can find, if you have any topic you're interested in, search it and you'll find pretty much a very deep dive tutorial into what's going on. We also do once a week webinar workshops. This is what a lot of folks really like. We have these once a week Thursday workshops. We had one last night, 2 nights ago, I apologize. 2 nights ago, we did Rite Aid. So everybody comes. We usually have a couple, maybe 50 to 100 people who show up out of all the people who are part of our program. They throw tickers at us during the first 10 minutes of the call. We go through and we pick the best of the best. And then after picking the best of the best, we take the rest of the hour and we go through the planning. And then we give everybody the plan so that they don't really, we like to earn while we learn. You take the plan and you can actually go with it the next couple of days and trade it. Every Thursday, you get a fresh plan. So not only are you learning on Thursdays how to do this, you're also getting handed to you on a silver platter a fresh plan. Plus, any questions you have, you send it to us by private message and we answer right away. In fact, one other thing I always offer, and that is I want all of you, when you're about to do your first position, to send your work, the plan, to me. And I'll review it and I'll make sure that you're not going to do anything stupid, right? Because I don't want you to be like me and lose $87,000 the first time you try our program. I have a double your money back guarantee. Try my system for the 6-month program. If you don't make money by the end of the program, not only will I refund the amount that you put into this, I'll give you twice. And that's how confident I am that if I can teach those inner city kids how to do this in a 6-month program, I can teach you in a 6-month program. And I know you probably have access to computers. You don't have to be going to the public library. So, and you probably, most of you have more than a 4th grade education. So this is what you got to do. Go right now. The website is optioninvesting.org/TTL. You can also, if you have your mobile phone, you can just scan the screen. Don't pass go. Don't collect $200. In fact, let's test this really quick. I'm going to come back to my browser and I'm going to type in optioninvesting.org/TTL for Traders Talk Live. And you should come to a page that looks like this, where you can learn more about our program. Tells everything that's in it. The 6-month program, there's no recurring charges. There's nothing like that. And you'll notice, I think Teddy went ahead and put the link right into the chat box. The price is $497. It's one flat fee. Again, no recurring charges. And again, there's the double your money back guarantee. You can pay by PayPal or credit card. And we do limit the number of traders we take in at any one time because I give so much personal attention and review so many sites. So please sign up soon. I think that's going to be amazing. Don't pass go. Don't collect $200. You deserve it. Not only that, your loved ones deserve it too. Guys, this is my email and my phone number. You're welcome to give me a call at any time if you have any questions. I love to banter about trading. Please visit that website, optioninvesting.org/TTL. Check us out. Hope you got some good notes today. And it looks like I'm at the end of my hour. I see some questions, but give me a call or send me an email if you'd like me to answer your questions. I want to respect Teddy's time and respect the next speaker's time. Please check me out. Thanks, everybody.